Interest rates just went up again in Australia. So on the 16th of March 2026, the Reserve Bank raised the cash rate to 4.1%. And here's what makes this different. It passed in a 5-4 vote. That means even inside the RBA, there's serious disagreement about whether this was actually the right move. I'm Diana Hamad, mortgage broker and ex-banker who structured over $500 million in property financing. I want to break down exactly what's happening with rates, why the experts can't agree, and what this means if you're investing in property or planning to. Let's get into it and stick around to the end of this video because I'm going to share something that will completely change how you see this market right now. So what just happened? The RBA raised the cash rate to 4.1% in a split decision. A 5-4 vote tells you this wasn't clear cut. Half the board thought the rates needed to go up to control inflation. The other half thought we were already at risk of going too far. That level of disagreement at the top should tell you something. No one actually knows how this plays out. Okay, they're kind of just guessing at the moment. It's almost like COVID. Now, here's what RBA Governor Michelle Bullock said about the decision. She said inflation is still too high and we need to be confident it is returning sustainably to target. She also made it clear that they're trying to thread the needle here. We're not trying to engineer a recession, is what she said. But here's the reality. Raising rates slows spending. Slowing spending can lead to job losses. So even if they're not aiming for a recession, it's still a real risk when you're tightening this aggressively. Now, let's talk about what the economists are saying, because this is where it gets interesting. They're split in two camps, and depending on who you listen to, you get a completely different view of where we're headed. Camp 1 effectively says more rate hikes are coming. Okay, these economists argue that inflation is still too stubborn, the job market is too strong, and people are still spending too much. Their view is pretty simple. If inflation doesn't fall, rates keep rising. They think the RBA might need to go to 4.5 or even 5 to actually bring inflation under control. Now, Camp 2 says this could go too far. These economists are warning that households are already under serious pressure, especially mortgage holders, and pushing rates higher could tip Australia into a downturn. Their argument is that we're close to breaking point, and 1 or 2 more rate hikes could be the thing that pushes the economy over the edge. So like I said, depending on which economist you listen to, we're either not done hiking or about to overcook it. That's the level of uncertainty we're dealing with right now. To add into that mix, okay, we have what's happening globally at the moment. So obviously what's happening globally at the moment is also going to factor into this. Within this video, I'm just specifically talking about interest rates, but it's very important to mention and note, due to global uncertainty and what's happening around the world, it may also impact the rates, inflation, and the activity that's happening in the country. Obviously, we all know petrol prices are through the roof, so we can already start to see a bit of an impact of what's occurring. Now, then you've got the political side of all of this. So you've got the RBA, you've got the economists, and now we've got the politicians, okay? And it gets messy pretty fast. So Treasurer Jim Chalmers is pointing to global issues, like I just said, saying inflation pressures are being driven by things like war, oil, prices, and supply shocks. His argument is that this isn't a domestic problem, it's a global one, and the RBA is doing what it has to do in response to forces outside of Australia's control. Now, the opposition argues the opposite, of course. They say government spending is keeping inflation high and forcing the RBA to raise rates further. Their view is that if the government wasn't spending so much, inflation would already be under control and rates could start coming down. Now, both are probably true. I think both are probably true. So, depending on who you ask, it's either a global problem or a government-made one, and that political disagreement matters because it affects what policies get implemented going forward, which affects how long rates are going to stay high. Now, let's top it off a little bit. Here's where it gets really interesting. Christopher Joy, who's one of Australia's most vocal economic commentators, is not holding back, and he never does. He wrote that spendthrift Aussie politicians bear the blame for persistent inflation. His argument is that the issue isn't just interest rates, it's the policies behind them. He's saying politicians on both sides have been spending too much, and that's why inflation is sticky and why the RBA has no choice but to keep rates elevated. Now, Joy also warns that this could mean that rates stay higher for longer and the pressure on households doesn't ease anytime soon. His view is that until government spending gets under control, the RBA is stuck, in this position of having to keep rates high to offset fiscal policy. And I've spoken about this before in one of my videos, and looking at, we've got fiscal policy, we've got monetary policy, and how they're treated separately, but they're actually completely linked, and they affect and they impact one another. Because you've got the government spending, okay, and then government spending leads to the RBA, which is, monetary, and the RBA having to rise rates to keep things under control. So what happens, like what happened during COVID, was that the government spent a lot of money too fast, okay? They spent lots and lots of money. And so we had Job Seeker, Job Keeper, we had all these different things that the government was spending money on. And what happened was none of it was for free. So effectively now, okay, and in the past, when the rates started to go up, the Australian people, with the RBA having to rise rates in order to manage what's happened due to inflation and government spending. So that's effectively how it happens, and that's one of Chris Joy's main points and main discussions, is about fiscal policy, monetary policy, how they affect each other, and how the government spending is actually causing a lot of this. They're all the perspectives, okay? That's what everybody's saying at the moment. But I actually want to get into what does it actually mean if you're planning on investing in property, okay? If you're already investing in property, and how it's going to impact you. And then at the absolute end of this video, I'm going to break down a perspective that I think it's very important you keep in mind if you want to grow. It's a perspective I'm having. It's a perspective I had in COVID, and it's helped me to be able to get to this point. But let's start with this. So what does all of this actually mean if you're investing in property or planning to? Let's break it down into what matters practically. First, if you've got a mortgage, this rate rise has probably hurt you a little bit, I understand even a 0.25 increase can add quite a bit to your monthly repayments. But I said it in one of my videos online. I said it's pretty much the same position we were in before they started dropping the rates on us. So yes, it's annoying, but it's okay. Like, you're going to be okay because we've dealt with these higher interest rates before, and we can deal with them again, hopefully. But I'll give you an idea of what it looks like in terms of additional repayments. So if you're on a $1 million loan, and it's an extra $150, $200 a month. So if you've got multiple investment properties, obviously, then they're all going to go up. A way for you to be able to manage your repayments on everything, make sure your investments are interest only, okay? Make sure your mortgage broker is always on top and reviewing your interest rate for you. Like, I know with our clients, we're always on top of it. We're calling the lender to say, hey, can you get my client's rate lower? Yes or no? If they can't come to the party, we're seeing who can come to the party for it. Have a buffer, have a cash flow buffer in your account for repayments, so that if rates do go up, then you kind of have a buffer there. Like, if they're investment properties, and if your rent isn't increasing as much as you would like to, with the rate rises, like let's say you're in a lease and you can't raise the rents on the tenants in the property, then effectively what you then want to do is just have a bit of a buffer in your account to make sure that you can make up that shortfall, put the repayments on interest only to free up cash flow for yourself, and then you should be good. Okay. If it's your actual house that you live in, then it just might be a matter of obviously also having some sort of a buffer in your account, making sure your mortgage broker is hounding the banks to get that rate down for you, and then at the same time, maybe just budgeting, cutting costs where you can, just to keep up with those repayments every month. The second thing that this impacts is borrowing capacity, okay? Because obviously when rates go up, borrowing capacity tightens. And every time rates go up, the banks assess your ability to service the debt at a higher buffer rate. So for example, the banks currently, let's call the rate 6%. The banks don't assess your ability to service a loan at 6%. They add a buffer rate. They add 3% to that. So they say, okay, can Diana, the interest rate's at 6%. Diana wants $3 million. Can she afford $3 million at 9%? They add that 3% to it, and that's how they assess it. Because that obviously protects you from times like this, that when rates actually do go up, to make sure you can afford the money. In saying that, it reduces your borrowing capacity for now, because even if you could borrow $1.5 million last year, okay, and your income hasn't changed, your circumstances haven't changed, you might only be able to borrow $1.3 million now. So if you're planning to buy soon, make sure you have a pre-approval in place to lock in your borrowing capacity. Okay, with certain lenders, it does. And at the same time, make sure that you have your lending structured correctly. Now it's important more than ever, especially with the rate rises, make sure your lending is structured correctly in such a way that it's not going to completely impact your borrowing capacity, so that you can keep buying and you can have the opportunity to keep growing even during this time. Now, the third thing is cost of living is still high. So inflation is still running above the RBA's target. That means groceries, fuel, energy, all the basics are still putting pressure on households. So for investors, that matters because your tenants are feeling it too. Rental demand is still strong because people can't afford to buy, but you need to be realistic about what rents the market can actually sustain, okay? Now, at the same time, if you're an investor, it also sort of not works in your favor, but you get support in the regards that if everything is becoming more expensive, including the interest rates, you can increase your rents, which means that the impact on you might not be so high. I say somebody who lives in their own home, okay, they're fronting all the repayments, they have no income for it. They're not receiving an income from the house that they live in, obviously, because they're living in it. They just kind of have to brunt the rise of the rates, okay, versus when you're earning an income from the property of which that you own, you can actually increase the rents on the landlords, obviously within reason and being fair, but it'll help you to manage the repayments on everything. All right, fourth, and this is a big one, uncertainty. Right now, no one agrees on what happens next. Some economists, like I said, think we're getting another 2 or 3 rate hikes. Others think we're 1 hike away from a recession. The RBA itself is split, okay, and that level of uncertainty make it hard to plan, and it can make timing your next purchase difficult, okay? But here's how I'm thinking about this as somebody who works with property investors every day. I'm a property investor myself. Rates are high. They might go higher, but that doesn't mean you stop investing, okay? It means you get smarter about how you invest. And if you're buying right now, you need to stress test your serviceability. This is what I wanted to say, and this is what I think it's important you listen to. Don't let rate rises paralyze you. Understand them, plan for them, and then keep moving forward. This is probably, like I said, the most important thing I'll say in this entire video. The biggest wealth transfers in modern history didn't happen during good times. They happened during exactly this kind of moment. The uncertainty, the fear, the headlines telling you to wait. Think about COVID. March 2020, the world was shutting down, borders closed, nobody knew what was happening. The people who bought property in that window, okay, some of the assets have already doubled in value. Think about the GFC in 2008, 2009. Banks were collapsing overseas, credit was freezing up, and the sentiment in Australia was pretty much paralyzing. The people who bought through that period built some of the strongest portfolios over the last 2 decades. You know, we all know that person that got rich because they bought properties during that time. And if we take it even further back, the early 90s recession, the dot-com crash, every single time the pattern is the same. Fear peaks, activity stalls, and the people brave enough to move when everybody else freezes are the ones who come out on the other side looking like the geniuses. Okay, here's the thing about hindsight. If you'd bought during that time and what felt like the riskiest moment, that property could have been worth 2, 3, 5, even 10 times what you paid for it. Okay. The risk that felt enormous at the time looks completely different 20 years later. And that's why it's a risk. Nobody sees a risk as an opportunity, but it's absolutely an opportunity if you're doing it educated. So here's a trap I see investors that fall into right now. They sit on the sidelines waiting for certainty, waiting for rates to drop, or waiting for the news to feel better. And then when rates do start coming down, when everybody agrees it's safe again, when the headline turns positive, they jump in. But by that point, you're not buying at the bottom of the cycle. You're buying with every other person who was too scared to move, which is 99% of the population. You're competing it back again. Okay, you're paying more and you've given up years of growth, years of equity, and years of compounding that you're not going to get back again. The people who hold off during the hard times, then scramble to get in when everybody else is going, end up right back where they are today, wishing they'd moved sooner. And that's the thing about risk, is that it doesn't feel good at the time. It feels scary, but it pays off. Australia's wealthiest property investors were not built in the easy markets. They were built in markets that looked exactly like this one. So the question isn't whether rates are high. The question is whether you've structured your finances well enough to move while others won't. If you have, this could absolutely be your moment. So to wrap it up, the government's undecided, the Treasury doesn't really know what's happening, the RBA is increasing rates, and economists are split. Everybody is split. During a time like this, it's important that you have a clear strategy and structure in mind. Don't let the media freak you out or scare you. It's not going to help anything. Focus on your household, focus on your goals and what you want to achieve, okay? And have a plan towards that, because we can't control these things. Control the controllables, okay? Which is yourself, your plan and your goals, and stick to them, especially during times like this, because like I said, this is where a lot of millionaires are made. I hope you enjoyed this video. If you did, please like and subscribe to my channel, because we upload new videos every single week. And if you have any questions, please leave them below. Thank you.